Warren Buffett just did something he's only done twice before in 60 years, and both times, a massive market crash followed within months. Here's what's happening. Berkshire Hathaway's cash position just hit $382 billion. That's more than Apple, Amazon, Google, and Microsoft's cash combined. It's enough to buy every NFL team and every NBA team and still have $34 billion left over. But here's the part that should terrify you. Buffett has been a net seller of stocks for 12 consecutive quarters. That's 3 straight years of selling more than he's buying. In 2024 alone, he sold $134 billion in stocks, the most he's ever sold in a single year. And it's not just random stocks. He slashed his Apple position by 73%, from $200 billion down to $60 billion. He sold 44% of his Bank of America stake. He dumped 26% of Chevron. He completely exited dozens of positions. The S&P 500 is trading at 22 times forward earnings, a level rarely seen since 2000. The CAPE ratio just hit 40 for only the second time in history. The first time was right before the dot-com crash. The Buffett Indicator, his favorite valuation metric, is at all-time highs, showing the market is drastically overvalued. And Buffett is retiring as CEO on December 31, 2025. He's handing over Berkshire to Greg Abel with the largest cash pile in the company's history, positioned perfectly for a crash. In this video, I'm exposing why Buffett is selling everything, what the historical data says happens next when he does this, which specific stocks he's dumping and why, and exactly what you need to do right now to position your portfolio before the crash he's clearly preparing for. But before we dive in, if you want to protect your wealth and avoid losing 30–50% in the coming crash, make sure to subscribe and hit that notification bell. We're exposing market warnings that could save your portfolio. Now let's get into it. The $382 billion warning signal. But there's one historical pattern about Buffett's cash hoarding that is by far the most predictive of market crashes, and almost nobody is connecting the dots. It's the cash-to-portfolio ratio. And when it hits certain levels, a crash always follows. Let me show you the pattern. Right now, Berkshire has $382 billion in cash and only $312 billion in stocks. That means cash exceeds the stock portfolio value. The cash-to-portfolio ratio is 122%. This has only happened twice before in Berkshire's 60-year history. The first time was in early 2000. Buffett's cash pile was growing while he refused to buy tech stocks during the dot-com bubble. Everyone thought he was crazy. Buffett doesn't get it, they said. He's missing the new economy. Then in March 2000, the Nasdaq crashed 78% over the next 2 years. The S&P 500 dropped 49%. Buffett was right. His cash let him buy bargains during the crash, while everyone else was selling at losses. The second time was 2007–2008. Buffett built a massive cash position while refusing to buy overvalued financial stocks and real estate companies. Again, people questioned him. Why isn't Buffett buying? The market keeps going up. Then in October 2007, the market peaked. By March 2009, the S&P 500 had crashed 57%. The financial crisis wiped out trillions. But Buffett deployed his cash at the bottom, investing $5 billion in Goldman Sachs, $3 billion in General Electric, billions more in other distressed companies. He made tens of billions in profit. Now it's happening again. The cash-to-portfolio ratio is 122%, higher than both previous times. Buffett has been a net seller for 12 straight quarters. He sold $24 billion in the first 9 months of 2025 alone. And unlike previous periods where he was waiting a year or two, he's been building cash for 3 years straight. The data is clear. Buffett sold $134 billion in equities in 2024, nearly doubling his cash from $167 billion to $334 billion in 1 year. Through Q3 2025, it grew to $354 billion. By Q4, it hit $382 billion. That's a 129% increase in 18 months. And here's what makes this time different. Buffett is retiring. He announced in May 2025 that he's stepping down as CEO on December 31st. Greg Abel takes over January the 1st, 2026. Why does that matter? Because Buffett is positioning the company for Abel to deploy cash during the crash. He's handing over the largest war chest in Berkshire's history, so Abel can be a buyer when everyone else is panicking. Think about the message that sends. Buffett spent 60 years building Berkshire. He could hand Abel a fully invested portfolio of great companies. Instead, he's giving him $382 billion in cash. Why? Because Buffett expects a crash so severe that buying opportunities will be better than anything available today. An analyst from BigData.com said, Buffett's actions over the past year have been a textbook example of positioning for turbulence. He has no interest in timing the market's bottom, nor does he chase short-term rebounds. Instead, he waits for moments when fear drives prices to levels where the risk-reward equation tilts decisively in his favor. Buffett's cash fortress isn't defensive, it's offensive. He's preparing to attack when valuations collapse. But it's not just the cash position that's signaling a crash, it's what he's selling. This next category of stocks Buffett is aggressively selling reveals exactly what he thinks is most overvalued in today's market. It's his core holdings. And the scale of selling is unprecedented. Let me break down the numbers. Apple was Berkshire's largest holding, at one point worth nearly $200 billion. Buffett called Apple probably the best business I know in the world. He praised Tim Cook constantly. He said he'd never sell. But then in Q4 2023, he started trimming, and he didn't stop. Through 2024 and 2025, Buffett sold over 600 million Apple shares, reducing his stake by 73%. From $200 billion down to $60 billion, that's $140 billion in sales, the largest stock sale in Buffett's career. Why? Because Apple's valuation exploded. When Buffett first bought Apple, it traded around 10 times forward earnings. Now it trades at 33 times. The business didn't triple in quality, the multiple did. Buffett sees Apple stock as overvalued by 200–300%. So even though he loves the company, he's selling because the price doesn't make sense anymore. But it's not just Apple. Bank of America was another long-time holding. Buffett saved the bank in 2011 with a $5 billion investment during the financial crisis aftermath. He loved the franchise. He planned to hold forever. But then Bank of America's valuation went crazy. The price-to-tangible book value ratio approached 2, a level it's rarely hit since 2008. Banks historically trade at 1.0 to 1.5 times book value. At 2x, it's expensive. So Buffett sold 44% of his stake. That's billions of dollars saying, I like this bank, but not at these prices. He also trimmed Chevron by 26%, again citing valuation concerns. Oil stocks have run up, and Buffett is taking profits. But here's where it gets really interesting. Buffett also completely exited dozens of smaller positions. Stocks he bought just a year or two ago, he's already selling. D.R. Horton, the largest U.S. home builder, was bought in Q3 2023. Buffett made money on the position, then completely exited. Why? Because he sees the housing market peaking and doesn't want exposure when it turns. Nucor, a steel company, was bought in Q1 and Q2 2025. By Q3, he was already trimming. Clearly, he thinks steel prices and steel stocks have topped. VeriSign, DaVita, and dozens of other names all sold. Some positions held for years, others held for just months. It doesn't matter. If the valuation doesn't make sense, Buffett sells. The pattern is clear. Buffett isn't selling because these are bad businesses. Apple, Bank of America, Chevron, these are excellent companies. He's selling because valuations are insane. And this is coming from a guy whose strategy is literally buy and hold forever. His favorite holding period is forever. But when stocks get too expensive, even forever isn't long enough. Edward Jones analyst James Shanahan said, if you feel like stocks are expensive, including your own shares, you're eventually going to be right, but you can be wrong for a long time. But Buffett isn't worried about being early. He'd rather sell too soon than too late. For 12 consecutive quarters, 3 straight years, Buffett has been a net seller. That's not a quarterly rebalancing. That's not taking some profits. That's a systematic exit from an overvalued market. And when the greatest investor of all time spends 3 years selling, you should probably listen. But even more telling than what he's selling is what he's not buying. Here's the technical indicator that Buffett uses to value the entire market, and right now it's flashing the biggest warning signal in 25 years. It's the Buffett Indicator. And it just hit all-time highs. The Buffett Indicator is simple. You take the total U.S. stock market capitalization and divide it by U.S. GDP. If the number is over 100%, stocks are overvalued. If it's under, stocks are undervalued. Buffett once called it the best single measure of where valuations stand at any given moment. Right now, the Buffett Indicator is around 200%. That means stocks are valued at twice the size of the entire economy. That's never sustainable. The only other time it was this high, 1999, right before the dot-com crash. The indicator hit 150%, then the market crashed 50%. This time it's at 200%, even higher than the dot-com bubble. But it's not just the Buffett Indicator. Every major valuation metric is screaming overvalued. The S&P 500 price-to-earnings ratio is 22x forward earnings. The historical average is 15-16x. That means stocks are 30-40% overvalued based on PE alone. The CAPE ratio, cyclically adjusted price-to-earnings, just hit 40. That's only happened twice. 1929 right before the Great Depression and 2000 right before the dot-com crash. Both times the market crashed 50% plus afterward. Margin debt, the amount of money investors are borrowing to buy stocks, is near all-time highs. When everyone is leveraged and buying on margin, there's no buyers left when the market turns. That's when crashes accelerate. Corporate profit margins are at record highs. History shows profit margins are mean reverting. When they're at records, they always come back down. And when margins contract, stock prices crater. Every metric, valuation, sentiment, leverage, margins, all point to extreme overvaluation. And Buffett sees it. That's why he's not buying. In 2024, Berkshire bought $13.4 billion in stocks, but sold $134 billion. That's a 10.1 sell-to-buy ratio. For every $1 he spent buying, he took $10 out by selling. Even during the April 2025 market correction, when Trump announced tariffs and the market dropped 10% in 2 days, Buffett didn't buy. The S&P fell from $600 to $5,500. That was a $6 trillion wipeout, and Buffett stayed on the sidelines. Why? Because even after a 10% drop, stocks were still overvalued. A 10% correction from insanely overvalued just gets you to very overvalued. Buffett wants deeply undervalued. Kathy Seifert from CFRA Research said, valuations are still not dirt cheap. The cash Buffett has parked in Treasury bonds is yielding him a good return, and the competitive environment for deals has changed. Buffett is earning 4.5 to 5% on Treasury bills with zero risk. Why buy overvalued stocks that could drop 30-50% when you can make 5% risk-free? The math doesn't work. If stocks drop 30%, you need a 43% gain just to break even. But if you sit in treasuries earning 5%, after 3 years you've made 15% with no risk. Buffett is choosing the safe 5% over the risky stock market. That tells you everything about how expensive stocks are. But the scariest part isn't the valuations, it's the timing. Here's the most ominous signal that a crash is imminent, and it's hiding in plain sight in Buffett's retirement announcement. It's the timing, and it's eerily similar to previous crashes. Buffett announced his retirement in May 2025. He's stepping down December 31st, 2025. Greg Abel takes over January 1st, 2026. That means Buffett is retiring right at the peak of the market and then handing Abel the largest cash position in Berkshire's history to deploy during the crash. Think about the message that sends. Buffett is 95 years old. He's been CEO for 60 years. He could have retired any time in the past decade. Why announce retirement in May 2025 specifically? Because he sees what's coming. He built the cash fortress. He positioned Berkshire perfectly. Now he's stepping aside so Abel can execute the plan without any transition confusion. Buffett isn't abandoning ship. He's staying on as chairman. But by retiring as CEO, he's making it clear. My job was to prepare for the crash. Abel's job is to deploy the cash during the crash. And the data backs this up. Since Buffett announced retirement in May, Berkshire stock is down 12%, while the S&P is up 2%. That's a 14 percentage point underperformance. Why? Because Berkshire is holding cash instead of participating in the final melt-up. But Buffett doesn't care about short-term underperformance. He cares about long-term positioning, and he's positioned perfectly for a crash. Historical patterns show Buffett retires right before major turning points. In 1999, he was inactive and building cash. Then the dot-com crash happened. In 2007, he was building cash. Then the financial crisis happened. Now in 2025, he's built the largest cash position ever and is retiring. The pattern is clear. Buffett prepares for disaster, then steps back and lets the disaster happen, then deploys capital when others are panicking. And here's the kicker. Buffett admitted in his 2025 shareholder letter that he expects corporate taxes to rise. That's one reason he sold so much stock, to lock in gains at today's lower tax rates before future tax increases. But think about what that implies. If Buffett expects higher corporate taxes, he expects government deficits to explode, which means economic problems, which means recession, which means market crash. It all connects. Overvalued market plus rising rates, plus government deficits, plus recession fears, crash. And Buffett is positioned for exactly that scenario. Armando Gonzalez from BigData.com said, Buffett has no interest in timing the market's bottom. Instead, he waits for moments when fear drives prices to levels where the risk-reward equation tilts decisively in his favor. Buffett isn't trying to predict the exact crash date. He's preparing for inevitable correction whenever it comes. So what should you actually do with this information? Here's exactly what you need to do to position your portfolio like Buffett before the crash hits. Step 1. Build cash. Reduce stock exposure from 80-90% down to 50-60%. Move 30-40% of your portfolio into cash or short-term treasury bills earning 4.5 to 5%. You'll underperform in the short term, but you'll outperform massively when the crash comes. Step 2. Sell overvalued holdings. Any stock trading above 30x earnings is overvalued. Sell positions with PE ratios over 30. This includes most tech stocks, growth stocks, and meme stocks. Step 3. Avoid what Buffett sold. If Buffett sold 73% of Apple, maybe you should too. If he trimmed Bank of America and Chevron, consider doing the same. Follow the smart money. Step 4. Focus on value. Buffett is still buying, but only deep value. He bought Alphabet at under 20x earnings. He bought Japanese trading houses trading below book value. He bought OxyChem at a discount. Find stocks trading at 10 to 15x earnings with strong cash flow. Step 5. Prepare to buy the dip. When the crash comes and Buffett's positioning says it will, you want cash ready to Deploy, make a list of 10 stocks you'd love to own at 40–50% discounts. Set alerts. Be ready to buy when everyone else is panicking. Step 6. Stay disciplined. The market might go up another 10–20% before crashing. You'll feel stupid sitting in cash. But remember, Buffett has been building cash for 3 years. He's willing to underperform short-term to outperform long-term. Don't be the person who's fully invested at the top. So we've covered the 5 reasons why Warren Buffett is selling everything and preparing for a market crash. The $382 billion cash position that exceeds his stock portfolio for only the 3rd time in 60 years, and both previous times preceded massive crashes. The unprecedented $140 billion Apple sale and systematic exit from core holdings because valuations are insane. The Buffett Indicator at 200%, double the economy size, and every valuation metric at 25-year highs. His retirement timing in December 2025 after building the largest war chest in Berkshire history to hand able for crash deployment. And exactly what you need to do right now to position your portfolio before the inevitable correction. These are the warning signs that smart investors are acting on while the majority chases the final 10% of upside before the 50% crash. But here's something I didn't tell you at the start of this video. Everything I just shared is completely useless if you don't know which specific stocks will survive the crash and which ones will drop 70–80%. Without knowing which companies have fortress balance sheets and which are over-leveraged disasters waiting to implode, you'll buy the wrong stocks during the crash and lose money anyway. Comment under this video and I will reveal the 5 recession-proof stocks Buffett would buy during the crash, and I'll see you in the next one.